The best way to beat the market long-term is to buy high growth companies that can compound that growth over years or even decades. If you look at the performance of companies like Netflix, Google, Tesla, Booking, all of these are high growth companies that absolutely crushed the market because they disrupted an industry and ended up dominating the industry that they helped build. But who is going to be next? That's what I am looking for at Asymmetric Investing. And I'm providing research to my subscribers and showing you exactly what I'm buying. Today, I'm going to cover 3 stocks that I own. I'm going to cover 4 in total, but the three stocks that I own already are already up 62%, 254%, and 292% since I first covered them on Asymmetric Investing. It's these asymmetric returns, these huge winners that drive a market-beating portfolio. So if you want more, subscribe to Asymmetric Investing. There's a link on the screen and a link in the show notes to get all my research and find out what I buy every single month. It is the best value in finance. And before I get to the 4 stocks that I want to cover today, I want to thank this video sponsor, Fiscal.ai. This is the old FinChat. They have changed their name to Fiscal.ai, but they're providing all the same tools. And if you are not familiar with this platform, I'm going to use it throughout this video so you can see exactly why I'm so excited about it. It makes it really easy to find all the information you need to be a fundamental investor. And then they've got phenomenal charts. So visualizing how companies are changing is really easy. And the phenomenal thing that they do is their key performance indicators, KPIs. You can look up the drivers of a business, even the drivers of a division within a business. So I'm going to dig into that today. But check out fiscal.ai/ASYM. They'll give you 2 weeks for free of their pro version and then 15% off. This is a product I pay for, so I'm putting my money where my mouth is here. But let's get to the 4 stocks that I want to talk about today. The first is Hims and Hers. This is one of these growth companies that just keeps compounding like crazy. Since I first covered Hims and Hers on Asymmetric Investing, stock's up 254%. So just phenomenal returns for investors. This is still only a $12.4 billion company. Look, the valuation isn't all that bad. Enterprise value to sales is 6.8. That is actually pretty cheap when you consider their growth. Revenue growth over the last 3 years, 77%. That has actually accelerated. It's over 100% in the most recent quarter. That may come down a little bit in 2025 for reasons I'll get to in a second. But you can see that this has been an absolute rocket ship, as low as $6 per share in 2023 and late 2023. Now it is up 10x since then. And I think this still has 10x potential over the next decade. And the biggest reason is the compounding that's going on in the business. I'm going to get to their KPIs in just a second, but you can see that the high-level numbers are exactly what you want to see from a high-growth company. Total revenue compound growth rate since the middle of 2022, 76.4%. That's really amazing. Let's put in their total revenue change, and these are all trailing 12-month numbers. You can see here that this growth rate has accelerated over the past couple of quarters. That is in large part because of GLP-1s. They have been a compounding company in GLP-1s. That's what got them a lot of attention late last year, in the second half of last year, what drove a lot of their growth. That's changed a little bit this year. They're not compounding GLP-1s for basically any customer anymore because that FDA exemption that existed has been ended because GLP-1s, the traditional branded GLP-1s, are no longer on shortage. But they have started to make partnerships with those GLP-1 makers. Why have those pharmaceutical companies gone to Hims and Hers? Because Hims and Hers controls demand. This is the real key. What I'm going to pull up here is in their KPIs. This is the number of subscribers and then the monthly online revenue per average subscriber. So these are going to be the 2 drivers of the business. If both of these numbers continue to grow, then Hims and Hers is going to continue to grow. So you can see now 2.4 million subscribers for Hims and Hers, and that compound annual growth rate is 56%. So phenomenal compounding of that growth rate, and that tells you that customers are sticking with the platform. They're also spending more money, now $84 per month, and that is in large part because of GLP-1s. But Hims and Hers is expanding into more products. This is not just ED, hair loss, and weight loss anymore. They're moving into menopause. They bought a peptide company. They have a lot of opportunity to expand the offerings that they have. And that's why I think this is ultimately a company that has 10x potential. If you're still thinking about Hims and Hers as an ED company, that was just the Trojan horse to get into the business. That was the area where they could attract attention. They could do advertising online and they could pull people into the platform. But then once they're in the platform, you're able to offer more solutions. You're able to get to know your customers a little bit better. You're able to offer personalized solutions. And as your healthcare needs grow, and as the company's capabilities grow, the company will be able to service more of those healthcare needs. That's why the move to offer more artificial intelligence services in the future, something they are now building out, is going to be really critical. If you can just go to Hims and Hers and say, here's this issue that I'm having. What could that possibly be? If they have a solution for you, they're going to be able to connect you with a doctor, potentially provide subscriptions, and then even non-prescription services. They're starting to do this with weight loss, so they can offer workout plans. They can offer meal plans. There's a lot of ways that they could grow in the business and service an individual's healthcare need. And that is in large part because they're going against the insurance industry. They do not take insurance, so you're not tied to the restrictions of the insurance industry. I just think there's a ton of potential optionality for Hims and Hers. And as they continue to add more subscribers, and they've proven that they can now become a profitable company, management has said that their operating margin is going to increase 1% to 3% per year on an ongoing basis going forward. So if this is a company that can grow at 50, 60% over the next 5 to 10 years and can expand those margins from a couple of percentage points today to 15, maybe even 20%, that's how you get a 10x plus return from here. Hims and Hers, one of the biggest stocks in the Asymmetric portfolio. That's in large part because it's been such a phenomenal returner, but I'm not selling any of it because I believe in the future of this company. The second stock, actually a bigger returner, 292% in the Asymmetric portfolio, is Robinhood. Now, I have a little bit harder time making a value argument for Robinhood because even when you look at the price earnings multiple, that's 42 right now on a forward basis. It's almost 60. The price to sales multiple is about 20. So a lot of growth is already priced into Robinhood, but the tailwinds behind this company are too good to ignore. Now, what I'm going to do here is I'm going to just stack all of their revenue segments together here. Again, this is in the KPIs, and you can see that there's been some new drivers of the business. This goes back to the pandemic. Remember when Robinhood kind of jumped onto the scene? They were big into cryptocurrencies. That's the bright green. Options were a big piece of the business. They're generating about as much option revenue now as they were in the depths of the pandemic. And then you obviously had equities trading. That was their three biggest segments. Look at where we are today. The biggest segment for Robinhood is net interest revenue. So this is becoming much more of a financial services company than it is a YOLO trading company. And one of the reasons that I ended up buying Robinhood stock was because of this subscription called Robinhood Gold. Robinhood Gold gives you a bunch of advantages. You can get a higher annual percentage yield on the cash that you hold in your account. They'll give you boosts like a 3% match on contributions to retirement accounts. Again, this is another part of Robinhood's business becoming much more mature. They've moved away from that YOLO trading that we saw in 2020 and 2021. Now retirement accounts are growing about 9x year over year. This is a big reason for that. You have things like private banking that's coming in the fall of 2025. And there's the Robinhood Gold credit card. This is the crazy thing about Robinhood Gold. They lose money on every single transaction, but this is what brings people to Robinhood. It's how they're able to attract more assets to traditional brokerage accounts, to Roth IRAs, to traditional IRAs, and it's how they're going to grow their business long term. Now, there's a number of tailwinds behind Robinhood. One of the things that they talk about is their customer is typically very young. So they're moving into a higher earning stage of their careers. They're also going to be inheriting potentially billions and billions of dollars over the next 10, 20, 30 years. So that's a huge tailwind just from a generational shift. There's also geographic growth that Robinhood is going to have at their back. And the one that I'm potentially most excited about is their ability to increase the number of products that they're offering. I would love to have my kids' custodial accounts on Robinhood, but they don't offer that yet. And that's just one example of the kind of area where they can expand just by expanding their capabilities. But this is still a relatively young company, but it's growing extremely quickly. And like Hims and Hers, it is growing profitably. So this is the kind of tailwinds that I want to ride for decades with Robinhood. That's why I own stock. That's why I'm not selling any of the shares despite almost 300% returns on this stock since I first covered it on Asymmetric Investing. Love what they're doing. I would love to buy more shares of Robinhood stock if there's a pullback. So we'll see where the stock goes. If you want to know what I'm buying each month, check out Asymmetric Investing. There's a link on the screen and a link in the show notes. I tell readers all of my trades before I make them. I make them at the beginning of every single month and then over-index on never selling. I want to never sell the stocks that I buy each month because that's how you compound those gains. Let's go to the third stock that I want to talk about today. That is On Holdings or On Running. When a lot of people look at On Holding, what they see is a fashion company, another shoe company like Nike, like Hoka. And that's something that a lot of investors don't want to invest in. But there's more to ON than that. Let's go through the high-level numbers here first. $17 billion company. This looks very expensive. Price earnings multiple 67. On a forward basis, price earnings multiple is about 41. The enterprise value to sales is 5.2. Keep that one in mind. Now, I bring enterprise value to sales up because Nike is still trading at about 2 times sales. Nike's 3-year growth rate is 0.7. Their 5-year growth rate is 3%. ON's 3-year growth rate is 46%, and their 5-year growth rate is 54%. So yes, ON is trading for a premium versus Nike, but you're getting a much, much better company. And the reason that enterprise value to sales, I think, is more important and more indicative of the valuation of the company is because it is very hard to be profitable as a hard goods company when you're growing this quickly. Typically, you have to spend a lot of money on sales and marketing. You have to build inventory. That's why it's so hard to be profitable when you're growing. But look, ON is very profitable, $235 million in net income. Now, they report their earnings in Swiss francs, which kind of makes their income statement a little bit difficult to read because they do have currency fluctuations in there. But I'm just using US dollar numbers. And you can see that net income is a little bit volatile because of that currency volatility. But what differentiates ON is this right here. Their gross margin is over 60%. That is a phenomenal margin for a fashion company. And what really stood out to me in their most recent conference call, their first quarter 2025 conference call, is that they were the one company that I've seen that says, you know what, we might be impacted by tariffs, but we're not going to really worry about it because we're just going to raise prices. They are not telling investors, you know what, we've got this much impact because we produce this product here and we don't know what the certainty is going to be. Maybe we'll move some production here or there. They just said, you know what, we'll deal with it and we're going to push those prices higher for consumers because we want to be the premium brand. So they are the high growth brand and they're the premium brand. That is a difficult position to be in, but ON has been able to do that. That's why not a stock that I am selling. Shares are up 62% since I covered it first on Asymmetric Investing. And I think this is a kind of company that can compound those gains for the next decade or more. This is similar to what we saw with Nike in the 80s, 90s, and even in the 2000s. They just continued to grow as there was more awareness about their brand, and that awareness just keeps feeding on itself. The other thing to keep in mind is there's a lot of opportunity for growth. We look at shoe revenue. This is a vast majority of ON's revenue today, but apparel and accessories are where you could see tremendous growth in the future. Look, that is a tiny, tiny fraction of their revenue. And let's compare ON's size in their shoe sales to Nike. I still think this is crazy. The blue is Nike's footwear revenue. You can see that that's about $30 billion. ON's shoe revenue, $2.7 billion in the past 12 months. And I put Hoka on here just for comparison. ON is growing faster than Hoka, and it's even a little bit bigger than Hoka, but still could 10x in size and wouldn't be as big as Nike is. So I think this is a phenomenal fashion company. They continue to kind of defy the laws of physics. And I think that brand and that branding position that they have, premium position in the market, those high margins, that's exactly what you want to own as an investor. The fourth stock that I want to cover today, high growth company, is Taiwan Semiconductor. Look, if you are interested in artificial intelligence or in chips or in mobile phones, the company that you need to know is Taiwan Semiconductor because they make almost all of the chips for all of the high-end applications in the tech industry today. You can see that over the past 5 years, their stock has returned 225%. It's not as cheap as it once was, but it's still relatively inexpensive. Price earnings multiple is 17. Enterprise value to sales is 8, but this is a very, very high margin company. And just look at this steady growth for Taiwan Semiconductor over the past decade. You can see that compound annual growth rate, 17%, and their net income is growing even faster than that as they've had a little margin expansion. I think those margins are going to continue to expand in 2025 as they actually increase prices. They've got so much demand, especially for their AI chips, that they are able to increase those prices on customers. When a company like NVIDIA says they're extremely profitable, that they're generating 80% plus margins on their AI chips, Taiwan Semiconductor can go back to them and say, you know what, we want a little bit more of that margin. We're going to increase our prices just a little bit. That's going to help push their net income higher. They also have capabilities that just no one's been able to match. Intel has tried to keep up, but they have not been able to do that. This is the one foundry company that is just focused on its customers and focused on pushing their technology further. And this is one of the charts that I think is always crazy with Taiwan Semiconductor: return on invested capital. So what is the profit that you get from each dollar that you invest? Their return on invested capital right now is between 25 and 30%. That is just phenomenal returns. That basically means that they can just recycle the money and the profitability that they're making from the business and continue to grow in the future. They're going to be expanding more geographically. There's always going to be a push to more advanced chips. And I think Taiwan Semiconductor is going to continue to lead the industry. Like I said, shares aren't as cheap as they have been in the past. We've seen this stock trade for price earnings multiple in the 10, 11, 12 range, even in the last couple of years. But a price earnings multiple of 17 is not too much to pay for the leading chip maker in the world. I don't think that position is going to go anywhere. And if you're interested in the growth of any of these AI companies today, this is the company that they are going to be paying for the chips that they're making. So the 4 stocks that I covered today: Hims and Hers, Robinhood, On Running, and Taiwan Semiconductor. Which one of those is your favorite? Let me know in the comment section below. And don't forget to check out Asymmetric Investing. Again, I'm telling investors everything that I buy in that asymmetric portfolio, and that has absolutely crushed the market since I started it. You get all my deep dives, all of my strategic research, and my market commentary on a weekly basis. There's 4 emails a week for premium members. So would love to have you join that community. And of course, subscribe here on YouTube to keep up with all of my content. Thanks for watching, everybody. We'll see you here next time.